Smile big, look alive, and we are broadcasting live. Okay. Good to see all of you VIPs and other folk in the house. And I'm going to go ahead and share my screen, make sure I have audio. If you can hear me, you type number one in the chat box. See John's in the room. Big hi. He says hi, Greg, in the chat box. Can you hear me? Can you type number one in the chat box? Let me know that you can hear me. And if you can't, then I'll make some adjustments. Okay. And we'll go ahead and share our screen. I'm not seeing any number ones in the chat box, but I'm just going to go for it. Okay. All right. And let me go ahead. I'll stop sharing. Try that again. And share screen, share sound, and let's do this. Okay. And view and reading view. Okay. All right, ladies and gentlemen, welcome, welcome, welcome. Howdy to you all out there in YouTube world. We're streaming out there live from Las Vegas, Nevada. We're doing Bulls versus Bears, the strategic market forecast. My name is Dr. Greg McLeod. This is a presentation of Elite Traders University, professional trading operation. We teach people how to become professional traders in 90 days or less using my proprietary pip and run approach. Okay. And so we're going to be looking at the market. And guess what, guys? This peace in the Middle East and, up to the memorandum of understanding signed by President Donald Trump, who has done something that has not, basically we've been at war with Iran for about 47 years. And we brought this to a close, and a lot more to go to that, but we're seeing oil prices fall. We'll show you some charts on oil. We'll also show you how to actually trade. I don't want to give away the biggest, basically we're going to discover the best trade, how to trade peace. We learn how to trade war, and we're going to learn how to trade peace. And, being able to capitalize on market, on these big, the great thing about Forex is the ability to trade macroeconomic events or macro events, using the currencies of that. The currencies are the lifeblood of countries. Like SpaceX is the stock. You have the stock of SpaceX, and we had the terrific IPO, went from $135, got to a high of $200, right? That stock certificate represents the strength of the company, even though they have very little earnings compared to their valuation, but the belief in what the company can actually produce over time with space and orbital servers and things like that, it gives it that $1 trillion, making it one of the most valuable companies in the world. Well, similarly, the currency, whether it's the U.S. dollar or the Japanese yen or the British pound, represents the strength and the belief in a country, right? And so we've been playing that a certain way, and now there's going to be a paradigm shift that many traders need to wrap their heads around as we enter the Trumpian age, right? So let's go ahead and take a look at our charts, and let's go ahead and do this. Okay. Okay, so before we get started, I want to direct your attention to the risk disclosure on your screen to make sure you understand all the risks associated with foreign exchange trading. And I'm a 30-year trading veteran that worked at one of the world's largest Forex broker dealers in the world, Forex Capital Markets in New York City. So I'm a Wall Street, I got some Wall Street street cred. I'm also the founder and CEO of the Elite Traders University, and graduated from one of the top universities. But why you want to listen to me is because I have lots of experience in the markets, and I have trained thousands of traders around the world in becoming profitable and successful. And my insights matter. A lot of people value my insights. So, but this is not about me; it's about you. And we're going to go into our agenda. We're actually going to start with world news and economic reports. It's very important to understand the situation where that drives the currencies, the backdrop, what we're looking at. So let's go ahead and take a quick look see at the my market heat map and arrangement of currency pairs or percentage change. and we'll see what's popping, what's dropping, what's not. You can get access to this absolutely free just by scrolling to the front, and you have access to one of 6 heat maps that can help you direct where prices going. Right now, dollar Swiss is in the upswing green, so we would be buying the dollar Swiss. In fact, I'm going to go ahead and maybe take some profits in this trade right now. And we are going to go ahead and look at the economic calendar. You have access also to the economic calendar absolutely free. And we'll look at next week's items. And we do have tomorrow. We do have some UK data. We talked about that last. No, we didn't. We didn't have bulls versus bears last week. So I'm sorry. We rescheduled anyway. But we do have UK data, so the pound will be in play on Friday with retail sales. Retail sales, the most modern economies, retail sales is the biggest driver of one of the bigger drivers of economic growth. Probably 70 or 80% of GDP is based on retail sales. So it's expected that retail sales is supposed to be on the upswing in the UK, which could make the pound dollar move higher. It has dropped quite a bit after the peace treaty was signed. And then we'll have some Eurozone PPI year on year. I was supposed to write the PPI stands for Producer Price Index, and this is the prices that the producers, the wholesale inflation year on year is supposed to actually rise from 1.7 to 2.5, and oil is going to be the culprit. But we're going to see a lot of these numbers reverse because of the key component to many items that we buy, whether they come on trucks or airplanes or ships or railway, that there's a petroleum part of a component of their pricing. So when that input goes down in price, it dramatically impacts what we pay for goods and services, and so the price, we would see inflation actually be on the downswing, right? So so many of these numbers are backward looking because they look at the previous month or the previous year. And then we have some Canada retail sales numbers coming out as well. They're looking like they're a little softer. CAD has been on the ropes, and that's been one of the biggest trades in the last couple of days, is shorting the Canadian dollar and being long Aussie CAD or long Kiwi CAD, anything, just anything, Zimbabwe, that's currency versus CAD. CAD's in the weaker state. Okay. But let's go ahead and look to next week. Okay. And show. There we go. So we do have some Chinese data, and again, we don't trade the Chinese currency, but the Aussie dollar could be impacted by that if it's economic. This is like loan prime rates, probably not. Let's look at Monday, June 22nd. More Canada data, core inflation rate. Core inflation is supposed to rise from 0.2 to 0.5. CPI trim mean year on year, 2%, supposed to rise to 2.1%. Again, core inflation, we talk about core, it's without, you take out volatile food and energy, right? However, energy is in everything that we buy, really. So that number, a lot of these blips that we see, and that's why you're seeing a lot of central banks not raising their interest rates, because they say we raise interest rates to fight inflation, but inflation is transitory, meaning that it's going to pass. This too shall pass. That, well, if we hike interest rates, but all of a sudden inflation drops like a 0.5% next month because oil prices are lower, energy prices are lower, transportation costs are lower, and then goods and services. So basically, they have over tightened. They raised rates when the inflation was actually on the downswing. So you have to, all these you take with a grain of salt. There might be some knee-jerk reaction to the higher inflation, but usually inflation boosts the currency. The Canadian dollar has been very, very weak, and so these inflation numbers may only provide short-term relief in the short run, and it can be used when you're trading. When these numbers are released on Monday, could give us an opportunity to short the Canadian dollar at a higher level, right? We'll talk more about that when we get to the Canadian dollar forecasts, dollar cash forecasts. We have the consumer confidence flash is supposed to actually rise from -19 to -17. And then we're going to have some Aussie CPI. I'm not going to go over the medium ones. I'm going to go ahead and filter for just the high impact items. You can go to the filter, and that way the higher impact items will create more positive or negative pit movement, more volatility than the medium and lower items. So moving on, we have the French flag, fund of flags. So this is Eurozone, French and German flags. And we have PMI services. Basically, they look relatively unchanged, only a difference of a point or two. So not much change there. Then we have some UK data coming out at 4:30 a.m. Eastern time. And then our 10 o'clock news cycle actually starts a little early at 9:45. We have the S&P Global PMI Flash Composite supposed to drop from 51.5 to 50.6. And these are the estimates, but lately these bean counters have been wrong. They've been pretty wrong. So since they've been wrong, and they surprised to the upside, this could cause the dollar to actually strengthen because they are, maybe they say it's lower, 55 is 54, comes out 56. Well, the market has to price in for that because they're looking at the projected number and placing a value on the US dollar. But then we have a higher number. Well, then they have to adjust because the market is a discounting mechanism. It's supposed to know all, everything ahead of time. But if it gets it wrong, which it does, well, then there has to be there's a repricing, and that creates trading opportunities. When there's a difference between the forecast number and the actual number, when you have a difference between those two, the bigger the difference, the more volatile the move. Okay. So we have all that there for the U.S., and then we have Australian data coming out at 9:30. We have RBA weight mean CPI, which is Consumer Price Index year on year, supposed to rise from 3.5 to 3.7, and the trend mean CPI year on year is supposed to rise from 3.4 to 3.7, and the inflation rate year on year, of course, because of oil, rising from 4.2 to 4.9. Then we have the CPI 102 to 103. Then we have lots of data on Wednesday. The Australian dollar will be really in play. They don't have a forecast for part-time employment, full-time employment. The employment numbers are pretty volatile, though. We can see negative 18.6 thousand, and then jumps to 30,000. I mean, if this comes out better than this number, well, we could see a large, sizable move in the Australian dollar. Unemployment rate drops from 4.5 to 4.4%. Participation rate stays the same. Thursday, we have German consumer confidence supposed to drop from negative 29.8 to negative 30. And then we have the 8:30 U.S. news cycle. Lots of news, lots of stuff that the Fed's going to be watching. Core PCE is one of their favorite inflation measures that they look at. They look at PCE, and they're going to see if it's too high or starts rising, then they're probably going to want to think about pricing in a rate hike, which they have mentioned. 3.3 looks in line. Their goal is to get it down to 2.0, so it's still elevated, but not significantly. Core PCE prices quarter on quarter. Quarter on quarter is going to be volatile because it's every 3 months, and it rose from 2.7 to 4.4, probably due to oil, right? But this might be a big red flag for them. So you might see the dollar jump if this comes in at 4.4, if it comes in less than that, then we could see a dramatic drop in the U.S. dollar. Personal income month on month rise from 0 to 0.1. I know people will be happy to hear about that. Personal spending month on month supposed to decrease from 0.5 to 0.4. And the core PCE, that's minus volatile food and energy, supposed to rise from 0.2 to 0.3. As I said, and even though they call it core, and they take energy, volatile energy out, energy is in everything that we buy and need. Arrives on a truck or a car or a or an airplane or something. It's some type of shell or ship. So there's energy involved in the pricing. So, but this takes out like you buying your gas at a gas station or buying your electricity, right? Which can be very expensive this seasonally because of hotter temperatures, more use of air conditioning, and then you're gonna have higher utility costs, right? So seasonally, you're gonna have seasonal rises in inflation due to maybe summer travel and buying more fuel or plane tickets and things like that, right? GDP growth rate quarter on quarter 0.5 to 1.6. So growth is good. Typically, to grow jobs, you need GDP up at about 3 or 4%. And the higher oil prices probably have been a drag on GDP. Michigan consumer sentiment. This is going to be very interesting to see. A rise from 44.8 to 48.9 is very good. Means that people are happy or happier or more optimistic, right? At least people in Michigan anyway. And Michigan is a hard hit state, with the deindustrialization that's happened in the previous years. And if they're rising, by 4 points, that's big. That's really big, and it's a credit to some of the fiscal, the economic policies. Bringing more industry, bringing back the manufacturing to the United States has been very, very helpful in doing that and creating a new era of prosperity. Okay, all right. Enough of the fundamentals. Let's get to the technicals. We're going to go to our charts. Let me go ahead and stop sharing, and I'll set the chart up so we'll see all the garbage going on, right? And so we're going to be we're going to start the U.S. dollar index, and that is a basket of currencies based on percentage change. We'll see what's rocking there, and then we'll drill down to the euro, which is the anti-dollar. The anti-dollar is our, is the euro, basically the United States of the United States of Europe, right? So let me go ahead and James, hey, I see James is in the chat from YouTube. Big howdy do to James. Howdy, James. James is one of our contestants or one of our challengers in the 50 to 50,000 challenge. So good to see you, James. Be safe. I know James will hop on the calls while he's driving, but he's a safe driver and an awesome trader. Glad to have him aboard, along with our VIP, John, Dr. John. Good friend. Great trader as well. Okay, sharing screen. There we go. Here we go. Share screen. And then we'll go ahead and do the okay, bulls versus bears. Okay. And then so let's this is the dollar index. Dollar index on fire is rising, right? We have our moving averages. I'm going to leave those on there to give you a visual representation of where we are. But we're bullish when we have green candles above the moving averages. We're bearish when we're red candles below the moving averages, right? And if we're moving sideways, well, it's kind of a flat market we don't want to be in. So we're either above the market, below the moving averages. Why? Because bulls hit up prices with their horns, right? They strike with their horns. Bears strike down with their paws. So that's the origin of bulls and bears, right? Why we use that terminology, right? Why don't we say lions and tigers or cats and dogs, right? It wouldn't be really the same if you say, oh, cats and dogs, I'm really doggish on this stock. really more cattish, right? Anyway, we're not gonna be pussyfooting around here. Let's keep going. Moving right along, we have the U.S. dollar index. U.S. dollar index is very simple. Just draw a straight line, and hey, we want to be a buyer of the dollar. The U.S. dollar, higher highs and higher lows in the monthly chart. Each bar represents 30 days of trading activity. We're going to drop to a weekly chart where each bar represents 5 trading days of trading activity. 5, 5, 5, 5, 5. So 5, 10, 15, 20, 25, 30, 35, 40. We have been in an uptrend from a very long time here, right? But we're coming against the 200 simple moving average, which can act as resistance, maybe a temporary pause. We see we got to a high of 175 before pulling back to 100 spot 12. The trend is still intact, and so we would be buyers and not sellers. And so we would be, let's go ahead and move this down to the daily chart. And you can see this is our daily chart, each bar representing 1 day of trading. And we can see a big, huge bar, especially after we had the Kevin Warsh, the new central bank chairman, and he kept rates unchanged at 3.75%, and that caused the dollar to rise. Sometimes when a central bank does not hike rates but keeps them the same, it's still like a hike. It's bullish for the currency, right? So there are people there are about some dissenters on the board of the FOMC that want to hike rates because of inflation. But there were enough doves, people who didn't want to raise rates, to keep rates unchanged. And that caused this big move, this big bar yesterday, where we went from a low of 99.51 to a high of 157. And then we just built on that with another surge higher. We're running into some topside resistance. We do have old highs from the previous, from March 30th, 2026, right? And we busted through that. We didn't close above it. The wick just means the price hit there and pulled back, right? So that's we've pulled back, but we do have an inverted head and shoulders pattern that's working out here on this. So it could be long term. I was postulating that we would have, maybe after we had a piece, that we would have a return to the risk on the risk on Aussie dollar, Kiwi dollar, Euro dollar. But looking at this chart, we probably have a lot more upside in the US dollar for the foreseeable future, right? Why? Because we have large gaps that have not been filled in several months, that haven't been filled yet. These are these long vertical bars that we see. I interpret them here at Leading Traders University. We interpret these gaps as vacuums, and nature abhors a vacuum. So we look for a move, a commensurate move in the opposite direction. There's a 50-cent word for you: commensurate move in the opposite direction, right? Right, filling in, maybe getting back to this old high right here about the 146 area, near maybe 109 or so, a whole number, round number, where we actually dropped, right? We actually popped and then dropped, based a little cup and handle formation with a move back up to the old highs, right? And so consequently, bulls versus bears, we are bullish. Bye. Right. All right, there we go. All right, so let's go ahead and move on to the euro, the anti-dollar, and looks pretty sad. It's the opposite, right? Right, we have a large level of congestion here on the daily chart, monthly chart. Actually, we're in a huge downtrend. I mean, come on now. We are in a downtrend channel. Let's say that 5 times fast. Downtrend channel, trend channel. There we go. And there we go. We got this downtrend channel. We're hitting the top of that channel. We connect these two 2 swing points. Connect those 2 points there, right? We have 2 points. Old geometry 101. If you missed geometry or maybe you ditched school that day, 2 points connect the line. So we got 2 points, form a line, and we connect these 2 points down here. We have multiple points here, right? And then we have this point right there, right? So we can like multiple touches to form the bottom line channel. And so we look for price to return back to the there we go. We look for a price to return back down to the channel, right? Currently trading at the 114.70 or 1.1470. We're looking for price to continue to trend down the same way that the US dollar is trending up. We have a multiple, like a head and shoulders pattern here. We had the inverted head and shoulders on the dollar. We have this bearish pattern on the euro, and it looks like it could go in free fall. We just need to break some support. We have lots of support coming in here in this 114.31 area. Once we break there, we'll probably see lots of price action south side. Probably, I'm looking for price to get all the way back down to the 96.01 area. Based on the US dollar strength and the inability of this to make new highs. Because in fact, structurally, we have usually in an uptrend, we have higher highs and higher lows. Here we have a lower high and we're working on a lower low. So once we break below that low, it's like 114.12, we'll probably see faster moves. There's still hopium that people are trying to push price higher, but the bulls will probably be crushed. So we're bearish the euro. Okay, moving right along. Once you figure out these two, all the others are going to fall in line, right? We go over to pound dollar. Same thing, right? We've got the same kind of, probably not as weak, right? But still weak. So if we were like trading euro pound might be dropping, right? Faster than, because euro is weaker against the dollar. So, but we have the same type of head and shoulders bearish pattern. So we would be very reticent to go long. We only look to take shorts, right? That's the weekly, daily. Oh, the daily is just fell off the. Yeah, the daily just fell off the rock here, right? But then we broke the trend line. Again, we have our trend lines, right? It takes 2 points to make a line, right? Now, I took geometry too in school, and that's probably the only thing I remember from geometry, right? And a couple of things, corresponding parts of congruent triangles are congruent, all that stuff. But if you incorporate, if you remember, if we were to probably teach this in school, that you can make money learning geometry, I bet a lot of kids will pay attention to geometry. There's a lot of money in math, and typically Americans are not that great at math, right? And I was so at math, and that's why I really focused on my kids to master math. And in fact, when they were little, I would have them, their affirmation was, I'm a mathematical genius. Now, I'm an English major, so having your children grow up to be be proficient at math, but their essays aren't that great. I'm like, oh, wait a minute, you came from me, you should be able to write. Anyway, I digress. So here is our projection, right? We have an AB equals CD projection target of about 129.36 on the British pound. We broke the trend line. We hit the 618 projection. Our next target is here. So bulls versus bears, we are bearish the pound dollar. And the key is when trading this is not to trade the breakout, but wait for a retrace. The way you find the retrace, we teach this in the Elite Traders University, is to drop down your lower time frames and look for a rebound, because even though price is going down, you can still lose money going short, right? It's all timing, right? Like it's like telling a joke. You know, why did the chicken cross the road to get to the other side? Well, I messed that up because I just went right through it and didn't have the timing down, right? Uh, or to get away from Colonel Sanders, right? Uh, so here is you have this uh, this rally that we hit support. So you get short here, right? Because it's going down, Greg, like Greg said. And what happens is short-term chart doesn't care. Meanwhile, price is going to rally against you, guaranteed. Because if you've ever gotten into a trade, as soon as you got in with the wrong direction, and believe me, it's happened to me a few times, right? Where you get, because why? You see, look, lower highs and lower lows, just like they tell us, right? And then price rallies, right? Because it's oversold, right? It has to reload. There's no one left to sell. So it goes up a little bit, but it's going counter trend, right? It's going counter trend. So it's going to rally against the trend. It's going to get tired, right? And then it's going to drop some more, right? So it doesn't move price doesn't move in a straight line. So just because I tell you, hey, it's bearish, don't run out there and short it, right? You want to be like Snoop Dogg, sell high, and close it. Take your profits when it goes low, right? And now in this case, if you sold a breakout, it worked out. But if you sold here and rallied against you, and your stop is here, you're gonna get stopped out. It'll stop you out and then drop, then stop you out and drop, and stop you out and drop. You keep doing the same thing over and over and over again. So what you want to do is you want to sell high. So even though you've got a bearish scenario, wait for this to rise and give you almost like that, like in volleyball when they spike the ball up and then they set it up first. Wait for the setup, right? This is their setup, right? And I don't know how far it goes up for the setup. I don't know, right? And that's what we use Fibonacci, and those are things we go more deeply into mentorship. And if you have a couple of minutes, go ahead and you could book a strategy call with me, and I can analyze your trades and tell you more about what we do. Okay. So anyway, bulls versus bears. We are very be careful. But be careful, okay? In fact, tomorrow is Friday. We'll probably have a lot of profit taking. We'll probably see some reversals tomorrow. All right. So if you look at Aussie dollar, and it's the same thing. We have the same kind of big move. Let me reset this. Remove drawings and reset the chart. Okay. Same kind of thing. We have a very large downtrend that's gone on for a really long time, but we have had this rally that we've had going on right now, right? And now we have something called a harami, a small body candle inside a large body. In the old days, we used to use bar charts, right? And I used to use bar charts, and I actually used to draw this stuff out by hand. And so we have what we call an inside day candle, where we have a small body. We would have a candle inside of a larger body candle, and that usually is bearish, right? So this is what we used to use back in the day, right? And I use Hikinashi, but you might be more used to regular candles where they're more like this, right? So we have these small body candles, and then we look for a price to possibly, I use Hikinashi, right? For prices to come down even farther, right? Because we've struck this trend line. This was a counter trend rally. We were in a major downtrend. However, for the past couple of months, we have been moving up, right? And don't confuse a retrace to a major trend, because once it ends, then we could see a resumption of the downtrend, right? Just like we we have these incidents here where we have these rallies against the trend, right? And there's people that say, oh, but it's a downtrend, and they try, and then the market tears them up and then drops after they run out of money, right? So you want to make sure we have a change in structure, a break of structure. Uh, this is our weekly, is an uptrend, right? Our daily, though, is showing a change in structure. We're having lower highs and lower lows, and so we are bearish the Australian dollar, right? And this is all, and we would do the same thing with the New Zealand dollar as well. It's probably a little bit more clear. Where we move all the drawings there, and we can see that we're below the 200 simple moving average. Price is making new lows. However, we have a great deal of support here in this 55.69 area. And every time, well, it's in a downtrend, but buyers step up, and this thing rises like 2,000 pips, right? So how can you reconcile this? You got to go to the lower time frame to see what, at least a factor of 5. Whatever you trade on, go 5 times bigger to find out where it's going. And sometimes we go to a 4-hour chart or dealer charts, and we can see that we're below the nested moving averages, are 9 or 13 or 15, and then we're below our 200. So this would be bearish. However, there's lots of wicks here. Buyers are stepping in, they're nibbling. So you want to drop to a smaller time frame. Let's try a 15-minute time frame. And you can see that we are hitting on support. We're digging and digging and digging. We're not making new lows. And so if it fails, what happens is sometimes price will just jump up, flush out all the sellers, and then drop back down. So it does like a shamu, right? So just be careful, because just because it's pointing down, it's red below moving averages, doesn't mean it stays there. It'll jump on you, but then you're not going. Then you're in disbelief, because say everything that I know tells me it's going down, but why is it going up, right? But it will go up because it wants to get the most people on the wrong side of the trade. Because if they can get people to buy, right, that's what they're trying to do. They're trying the market mechanics. I'm not saying there's any individual covert force in there, but the market naturally tries to sucker people to the wrong side of the trade, because this is liquidity. These are people who are buying, and they have hope. They hope it's going to go up, right? In fact, I call it hopium. They're smoking hopium, right? And they might make money. You can make money on this counter trend, but you can't stay. You can't confuse this for a major trend. Once it's over and starts heading back down, right? Lower highs and lower lows, then we can enter, right? But if it keeps going up a little bit, right? Because now you got all these people in, I'm in. And now those people are long. They're long, and they're on the wrong side of the trade. Now price starts going down, and these people get stopped out. Why? They got long, and now it's, what's going on? I bought it. Oh, I got stopped out. The Forex is a stop-driven market. It's stop-driven. It's not so much value-driven or new. I mean, because it's like water. It's seeking its own level. So it's trying to find as many stops. Where are all the stops? If everyone is long, they've got stops down here, right? These are their stops. And when price hits those stops, price accelerates, right? So the stops of the bulls are fuel for the bears, right? So it's a stop-driven market. So if everybody is long and no one is short, there's no place for it to go but down, right? So keep that in mind when you are trading. Let's go ahead and go to gold. Gold is the same way. we have something where gold is an inflation hedge, right? But with there's no inflation, oh, well, the cost of carrying gold is pretty expensive if it's not making new highs. So we have a lot of people. A lot of people hopped on the gold bandwagon, right? And but the retail traders are usually a little late to the party, right? In fact, I wrote the Gold Rush Blueprint, which you saw. I wrote back in 2023, and it sold a few copies, and we sold a few courses, and we ran advertising. And my advertiser goes, "No one's interested in gold, Greg. No one's interested in gold." I go, "Okay, but it's going up, right?" But I tell you now, I am selling so many gold courses now and so many ebooks. I have people reaching out to me, "Hey, Greg, I want the Gold Rush Blueprint. Can you give me a copy of the Gold Rush?" I go, "Why are you trying to buy it now when I was trying to sell it over here?" Because retail people are behind. They're not thinking like traders, right? They're kind of late to the party. They saw it go up. Now they have proof. Well, gold is a good investment. Look how much money it made. And that's why there's always these warnings and all these financial sites that say past performance is not indicative of future results. Because the typical retail trader will look back here and go, "Look at this, is great," right? But an asset is only as good as its last performance. And this is its last performance right here, right? And it's down. But a lot of people look at this and go, "Wow, this is sexy. Let me go buy it because it's going to go up. It's going to go up higher to 6,000, 7,000, right?" I thought that too, right? But you got to understand the premise behind buying gold. We're buying gold to hedge against inflation. We're buying gold to hedge against a weaker fiat currency that is falling in value. That's been falling in value since Bretton Woods, since we went off of Bretton Woods. When we were on Bretton Woods, the dollar was backed by gold, right? And so 1 ounce of gold was $1. That kept inflation low, and we had a measure of prosperity. Somehow, some people talked us out of getting off of the gold standard, and so we saw the depreciation in the dollar, right? And runaway rampant inflation. We were having inflation in 2022 under the Biden administration. And so gold rocketed during that time, right? Our industrial base was hollowed out. Companies sent overseas. Now we have, America is the hottest thing going, right? And so now you have more investment coming into the United States, more factories, more jobs are coming back to the United States, more investment in steel plants and manufacturing and chip manufacturing. And so what is that going to do is it increases growth, and you can grow out of inflation. You can grow out of a deficit. Why? Because you're collecting tariffs. You have more people employed, more people paying taxes. And so inflation starts to go down. So why do you need an inflation hedge if inflation is going down? And that's what's happening. The market is a discounting mechanism. The market, the people in the market, the collective is saying, well, if there's no inflation, what am I hedging against? And if the dollar is going up, I'm not losing value, right? And so I know it was a long-winded story, but this is why I am bearish gold, right? I don't think this is just an ABC 3-wave correction against the trend. I think this is probably a 5-wave continuation, and we could see a move right back down to 3,000, right? Or more, right? Right. In fact, we might go back to where we broke out from. We were in this long consolidation in the 1025 to 1407. Structurally, if everything continued the way it was 2 or 3 years ago, Yes, we could have seen, but we're seeing assets that are not equity assets, not like the stock market because you're investing in companies, but things like Bitcoin and gold and silver, they're not really going up. The calculus has changed. The way we have calculated, it used to be when we had good U.S. news, the dollar would go down and all the other currencies would go up, right? Now we're seeing that when we have good U.S. news and good U.S. data, we've actually seen the dollar appreciate. And with those long-term dollar trends on the daily and monthly charts pointing up for the next foreseeable future, we could see a reversal where we could see the dollar rise when we have good news, and we can see everything else drop, which is the way it should run. Sovereign countries, if Australia is doing well, then the Australian dollar should benefit, right? If the if the if the British pound and the British economy is going well, the British pound goes up. That's how that relationship works. But for the past, as long as I've been in brokerage, uh, I think it changed like 2002, where positive U.S. news was negative for the dollar. And we're probably going to see something where just because we have high growth does not mean that we need to raise rates. And that's going to be tremendous. When we have low rates and high growth and no inflation, that's going to be the biggest calculus change. Because before, when we had high growth, there was a fear of high inflation, and then they hiked the currency, right? And that's what President Trump is saying, that you can have high growth and not have inflation, right? You don't have to put the brakes on. You don't have to, because when you raise interest rates, you lose jobs, you lose investment, you slow growth, you slow real estate development, you slow everything down. You put the brakes on when you raise interest rates, and so, in China, you've had 12%, 12% GDP, right? We said, well, 4% GDP in the U.S. and we're too hot, right? I know the Chinese economy is, they have a billion more people than we do, but we are still the number one economy. And so if their economy can sustain 12, 13, 14% GDP, there's no reason why the United States cannot have 5-6% GDP and not have inflation. Anyway, those are just my views of the market. I want to take a quick look at Bitcoin, BTC, USD, another digital asset. As it's also acting like a big, strong move. It was, in fact, Mark Cuban exited and said that he thought Bitcoin was going to be a hedge, and he says it's not a good hedge, and so he bailed on a lot of Bitcoin. And we are seeing support, though, in this 62,603 area. That's going to be kind of critical because everyone's expecting Fibonacci bounce, and even again, we're at the 618. This is a very significant. In fact, 618 is June 18th. It's my niece's birthday. 618. She's my Fibonacci princess, right? Happy birthday to Alexis. And so when we break down here, we get into the Fibonacci's of last resort, and there's going to be less interest in Bitcoin if we start hitting the 786 at 38,919, or the 88.6% retracement. We start getting those smooth jazz, the far part of the radio dial, the old AM dial or FM dial, the 88.6 and the college radio stations. Well, we start getting down here, there's going to be a lot less interest in Bitcoin. It could turn to be the biggest Ponzi scheme ever if we start breaking down to these levels, seeing lots of, and I've seen some bubbles, but this is pretty massive. We're not getting, we're seeing what could structurally have been a 1-2 and a bounce, but This is the key level, 57,609. We break below here. It could be, if I could find a way of shorting Bitcoin, I would probably look at shorting Bitcoin. The one I'm saving the best for last, and I tell you the currency or the instrument that I think you're going to make probably the most money on moving forward is oil. And oil is also in a big giant uptrend, right? It wasn't a trend, but this was driven by the Iran war. We just signed a monumental, historic peace. Congratulations to President Trump and being able to sign that peace treaty to end the war, to denuclearize that area, bring prosperity to the Middle East, and look to build relationships based on prosperity and independence and sovereignty, and not on revolutionary warfare, right, all the time, right? So what does that mean? Well, oil. There's a huge glut of oil. I was reading Reuters where there's like all these ships that the United States Navy escorted through. No one talked about it in the news, so it's not even really priced in, right? So we have as much oil that normally would go through the strait, 100 ships or so a day we're getting through, and that oil is online. America is now the largest exporter of oil. And people say it's for the first time. No, we were a big exporter of oil during World War II. We were a big exporter of oil to Japan. In fact, we stopped supplying oil to Japan because they were making war on China. And so we cut off oil, and that's led to the Pearl Harbor attack, right? You gotta read your history, guys. When a nation has their resources cut off, it's usually called an act of war. So I won't go into that. Let you do connect the dots on that. But we were the OPEC of oil back in the 1940s, 1930s, and so we're producing a lot of oil, a lot of fracking, a lot of oil production. You got Anwar in Alaska coming back online, and that's going to produce drill, baby, drill. We could see a drop to negative, right? Being able to take some short positions in oil. I am bearish. Yes, we are much higher. We were before the war. We were around $55 a barrel. We're at 79. So there's about a 20 barrel difference between where we are now and where we were before the war, right? So that represents a huge trading opportunity to take oil to the short side, or using an ETF to take advantage of this correction. The supply is basic supply and demand. When you have increased supply and decreased demand, then you're going to have lower prices, right? So we have that going on. So oil, we can drill down to oil, right? Hey, there's a play on words there. Here's our oil, and here we go, right? We're at 75, and we're below the 200 moving average, below the 20 and the 15. But we had a topping pattern, try to make new highs. Now we're making lower highs and lower lows. We have a change in structure, a BOS, we call a break of structure. We had higher highs and higher lows, and now we have lower highs and lower lows. We have this break of structure and the change of structure, a market change, right? And this was priced in. You gotta understand that, there are a lot of insider trading going on, exchanges of information between assistants and people in the government and military people, and they're talking. There's people sending out research, people listening in on what's going on in the Middle East, what's going on in Iran, what's going on with the ships. They have people looking at this stuff and pricing. They're not throwing darts at a dartboard. They're betting on sure things. It's a Reed Sun Tzu, The Art of War. Every battle is won before it's ever fought. So this stuff was dropping before the piece was written. Look at this. This is Wednesday, right? Right. We topped out with a lower high Tuesday of last week. Tuesday of no Tuesday. That was like May 17th. Lower high and a drop, right? And and then we had a little escalation, and then boom, right? So we have more to go here, right? And so with this information, we can, again, wait for some type of there might be a flat, there might be something. You understand too that other countries, North Korea, Russia, they're all trading this too, right? And sometimes we have certain things that might even happen to even push price in a one direction, because right now you missed it, right? You want it's going down already. You need look at that, got an alert, right? Because this is oversold. We'll probably see a bounce higher, right? And on that bounce higher, you could possibly get short at a higher level and look for a move down, right? Again, this is education, for purely education. No trade recommendations are given. Consult your financial advisor to see if trading oil is even right for you, right? I don't know. I'm just for entertainment and education purposes telling you that if you were to look at this market, you want to sell high after that, and we will look for next levels of classical support and resistance, right? I mean, if we get back down to this 67.39, that's an $8 move, and then there's no support levels down here at 62, more down at 58, and this takes us back to where we were before the war, around $55. That's a $20 move in oil. Again, there's ETFs and things you can use for that. So that's my big pick there. Okay. Well, guys, I hope you enjoyed being there. I wanted to encourage you. We're doing our $50,000 to $50,000 challenge that we've started here. This is I'll put the link there, where we take $50 as a starting balance, and we go ahead and sorry about that. Oh no, okay. This little pop-up keeps I know I need to expand this. Oh yeah, there we go. $50,000 to $50,000 challenge. You can join. We are having a special lifetime special. We're going to be talking tomorrow. We're going to do a webinar where I'm going to show you what we do in the $50,000 to $50,000 challenge and how you can actually use it, and actually give you a copy of the actual spreadsheet we use if you attend the workshop. That's going to be tomorrow at 2 p.m. Eastern time. Mark it on your calendars and tell a friend, and I'll show you how you can obtain lifetime founders access and also give you the spreadsheet. So make sure you show up. It'll be on the same link. I'll announce it in the school community. I'll be on I'll stream it on YouTube as well. 2 p.m. Eastern time. The $50,000 to $50,000 challenge, the great reveal, and our very special program. We're going to be offering a very special offer that I know that you'll packed with all kinds of bonuses and incentives to help you become a professional trader and be able to scale your account. I mean, we've got this wonderful tool that we're using now called the 31 Trade Blueprint, where we can actually enter our trades as we go along, download them from our platform, and actually start moving up moving up multiple stages in that tie into the blueprint, right? And then all the way up to our $50,000 target, right? So we do have this really cool. That's this will be when you join. If you choose to join, well, this will be one of the software. We also have other software that's going to be available too. That's part of this. We'll show you how all that works. The great reveal. It's tomorrow at 2 p.m. For the $50,000 to $50,000 challenge. So I hope for you to be there, right? Oh yeah, and Adrian has a question: Is it true drop can be 2 times faster? Yes, usually because what's the fear is greater than greed. You know, when something's going up, it's usually slow, and you know, and maybe it speeds up a little bit. But when people are fearful of losing money, they seem to sell faster. They sell faster than they actually buy, right? And so, especially if they're on the wrong side of the trade, I love shorting. I love being the bear, right? I could be bull or bear, but I like shorting. Okay. With that, ladies and gentlemen, I want to thank you so much for being part of our Bulls versus Bears. And so we'll see you at 2 p.m. on Saturday at 2 p.m. And we'll go ahead and give you the great reveal of our lifetime access to Bulls versus Bears, not Bulls, but to the $50,000 to $50,000 challenge. My name is Dr. Greg McLeod. Happy trading. Wish you all the best. Take care now. See you. Bye-bye.